Ladies and gentlemen, let us begin by looking back at history to place this problem in its proper context, because without understanding the past, we will forever be lost in the delusions of the present. I recall the tense days of the Cold War when nations wielded resources as a political weapon, and Venezuela under Hugo Chavez was no exception when they committed a fatal strategic error in the mid 2000s. The administration at that time, with the arrogance of power, demanded that Western oil corporations accept smaller stakes in projects without any adequate compensation. And this action was not merely an economic decision, but a direct challenge to the international legal order, leading most Western energy companies to choose to abandon the country rather than bow to those irrational terms. But history always has a way of calling in its debts in the most ruthless manner. And now, after 2 decades, we are witnessing the consequences of that irresponsible nationalization as companies like Exxon Mobil and ConocoPhillips are returning not to invest immediately, but to demand back tens of billions of dollars they assert Venezuela still owes them for confiscating assets illegally. The naked truth we must face right now is that there is no miracle that can revive the Venezuelan oil sector overnight, regardless of political promises or expectations from any side. And I must state plainly that the debt figures currently on the negotiating table are so colossal they could strangle any reconstruction effort if not handled with extreme skill. Specifically, ConocoPhillips is demanding compensation upwards of $12 billion, while Exxon Mobil, the largest United States oil company, puts the estimate at $20 billion. These are not figures on paper, but represent real financial scars, representing the capital, technology, and human talent that Americans poured in to build Venezuela's oil industry before the socialist regime stripped it away. And the harsh reality is that until these debts are resolved, or at least a clear payment roadmap exists, oil executives will be extremely reluctant to drop even a single dime into this bottomless pit. Because in the world of capitalism, an investment trust is not built on hollow pledges, but on the respect for financial and legal commitments. When we drill down into the situation from an intelligence and risk management perspective, we see a picture far bleaker than what the headlines describe, because the collapse of Venezuela is not just a legal matter of debt, but a systemic destruction of physical infrastructure. I have reviewed the data and seen that the nation's oil production once peaked at 3.4 million barrels a day in 1998, but went into free fall, dropping to just 1.3 million barrels by 2018. And this decline is the direct result of corruption, mismanagement, and prolonged neglect over the last 2 decades, making recovery not simply a matter of turning a valve. The Inter-American Development Bank has provided an estimate I find realistic yet challenging, that it would require $10 billion annually for a decade to restore Venezuela's production capacity. This poses the strategic question of who will put up that massive sum when the political environment remains rife with instability and investors are still haunted by the specter of asset expropriation from the past. We also need to take a sober look at the role and calculations of the current United States administration on this complex chessboard. President Trump has stated clearly he will defend the interests of United States oil companies and views Venezuelan economic recovery as a key objective. However, Washington's approach contains internal contradictions that a seasoned policymaker cannot ignore. Officials have said the United States government would take control of Venezuelan oil sales indefinitely, and the proceeds would first be used to stabilize that country's economy and only later used to compensate American companies. This is a bold but risky gambit because it places the United States government in the role of manager of another nation's assets, while simultaneously creating a resource competition between feeding the Venezuelan people and repaying energy corporations. And the stock market reaction has spoken volumes about that anxiety, as shares of Exxon Mobil and Chevron fell more than 5%, while ConocoPhillips dropped over 7% during the week of major political shifts. indicating that the investment class does not believe regime change automatically leads to profit or stability. Another aspect that requires dissection is the divergence in strategy among international oil conglomerates when facing risk in Venezuela. While the majority of Western companies, including European giants like Eni of Italy or Total Energies of France and Repsol of Spain, scaled back or departed after investing billions, Chevron stands as the only United States oil company that chose to remain. This is a strategic gamble where Chevron accepted political risk to maintain its footing, and now they may be in a potential position to reap significant rewards as the Trump administration presses Venezuela to accept greater United States investment. However, we must not be naive to assume that staying is a guarantee of success because the regulatory environment there remains a minefield. International arbitration bodies have repeatedly ruled in favor of ConocoPhillips and Exxon Mobil, but converting those rulings into actual cash is an entirely different story and incredibly difficult, exemplified by the fact that Exxon Mobil had a $1.4 billion arbitration award annulled, proving that international justice is sometimes nominal if there is no sufficiently strong enforcement mechanism. A pragmatic solution to this problem demands we set aside personal emotions and look straight at the core interests of energy security and regional stability. We cannot expect oil companies to return and pump money into a nation they view as having robbed them of their assets unless there are ironclad legal and financial guarantees. Therefore, the United States administration needs to establish a trust mechanism or a special legal framework where oil revenue is managed transparently by an independent third party to ensure that a portion of proceeds is automatically deducted to repay the debt to companies whose assets were seized, while the remainder is reinvested into essential infrastructure. Without this mechanism, every call for investment is just shouting into the void because, as one expert noted, the prior asset seizures were a stigmatizing action, convincing everyone they should never go back into that country. And to break this prejudice requires more than political promises. It requires real money and enforced law. Ultimately, the burden of all these strategic calculations and financial disputes does not just weigh on the shoulders of CEOs or politicians, but presses down on the fate of millions of Venezuelans living in deprivation. The failure to attract investment into the oil industry has been identified as one of the key drivers leading to the economic catastrophe of this nation. And if we in Washington or Caracas cannot find the equilibrium between demanding justice for corporations and saving a dying economy, then the collapse will continue and instability will spread. The responsibility of a superpower is not only to protect the profits of its businesses, but to architect an order where prosperity can be resurrected from the ashes of past mistakes. That is the hardest problem those in power must solve right now with a cool head and far-sighted vision.